Redeeming your property after a tax sale can be a complex process, but with the right guidance, you can navigate it successfully. The first step is to understand the tax sale process and the laws governing it in your state. When your property is sold at a tax sale, the buyer purchases a tax certificate, which gives them the right to collect the delinquent taxes, plus interest and fees, from you. To redeem your property, you will need to pay the buyer the amount they paid for the tax certificate, plus any additional costs they have incurred, such as interest and fees. The process of redemption typically involves contacting the buyer or the county treasurer's office to determine the total amount due. Once you have this information, you can pay the redemption amount and have your property restored to its original state. It is essential to act quickly, as the redemption period is usually limited, typically ranging from a few months to a few years, depending on the state. In some cases, you may be able to negotiate a payment plan with the buyer, which can help make the redemption process more manageable. However, this is not always an option, and you should be prepared to pay the full amount due to avoid losing your property to a tax sale in the future. It is crucial to stay on top of your property taxes and make timely payments. If you are experiencing financial difficulties, consider reaching out to your local government for assistance or seeking the help of a tax professional. Throughout the redemption process, it is vital to keep detailed records of all communications and transactions, including receipts and payment confirmations. This will help ensure that you have proof of redemption and can avoid any potential disputes. In conclusion, redeeming your property after a tax sale requires careful planning, attention to detail, and a thorough understanding of the process. By following these steps and seeking professional help when needed, you can successfully redeem your property and avoid further complications.